Hello there and welcome again to my channel. I'm Toyosi, and in today's video we'll be clearing up one of the confusions for new investors: ETFs versus mutual funds. What are they, how are they different, and which one might actually be beneficial to you? ETFs, which stands for exchange traded funds, and mutual funds are actually a collection of investments like stocks or bonds. So instead of you buying individual stocks or shares, you get to buy a small piece of a big basket of investments. Let's start with ETFs. ETFs trade on the stock exchange, and like every other stock, you can buy and sell them throughout the day, and its price also fluctuates based on demand and supply. ETFs are super flexible and you can trade them in real time. They also have lower fees when you compare them to mutual funds. So if you're someone who likes to be in control and to see real-time prices, ETFs might be your go-to. They're also good for passive investors because most times they track indexes such as the S&P 500. Now let's go to mutual funds. Mutual funds usually have fund managers who actively decide which investments to buy or sell, and because of this active management, mutual funds incur higher fees. But if you're looking for a professional touch to your investments, mutual funds could be your go-to. When comparing ETFs and mutual funds, both investment vehicles have their different pros and cons, and they depend on the market environment and also the type of funds. If you look at the expense ratios, ETFs generally incur lower fees when compared to mutual funds. And also with trading flexibility, ETFs trade like stocks, so you can trade them throughout the day. But with mutual funds, you can only trade them at the end of the day based on their net asset value. Also, when you compare performances, index-based mutual funds and ETFs usually have similar performances because they are tracking the same indexes. But mutual funds that seek to outperform the indexes usually have varied results. There are different types of ETFs. We have equity ETFs. These ETFs invest in stocks aiming to replicate the performance of a specific index. We also have bonds or fixed income ETFs. These ETFs invest in fixed income such as government bonds or corporate bonds. We also have commodity ETFs. Commodity ETFs invest in commodities such as oil, gold, or agricultural products, either by holding the physical commodities or through future contracts. There's also dividend ETFs. These ETFs invest in stocks that pay high and consistent dividends. Sector and industry ETFs. These ETFs gives exposure to a specific sector or industry, for example, energy, healthcare, technology, or financial services. We also have different types of mutual funds. We have equity funds. They invest in stock of companies, usually aiming for long-term growth, and they have higher risk but also offer more potential. Then we have debt funds. Debt funds invest in fixed income such as treasury bills, government or corporate bonds. They offer lower potential and also have lower risk. They are also hybrid funds. Hybrid funds is a mix of both debt and equity. They have moderate risk and offer growth returns. We also have real estate funds. This invests in REITs, real estate investment trusts, or direct real estate properties. So I hope you now understand the differences between mutual funds and ETFs. There are generally different types of mutual funds and also different types of ETFs that you can invest in. Most popular ETFs are those that actually track the S&P 500 index. There are also different types of mutual funds. Thank you for watching today's video. If you found it useful, give it a thumbs up and also follow at Toyosi's Finance Nuggets. You should also share with your friends that might be interested in investing and also the stock market. Remember to always stay smart with your money. Goodbye.